Good morning and welcome to the Killik and Co market update. We've talked about record highs for the S&P 500 in many of our recent videos, but there has been yet another one this week, and it's a particularly significant one because it's the first time in history that the S&P 500 index has passed through the 5,000 level. However, while the index is very closely followed by the media, it might not necessarily be the best benchmark for most people's portfolios. The S&P 500 focuses solely on US stocks, it focuses solely on large stocks, and furthermore it's what we call market capitalization weighted, and that means it focuses more on bigger companies and therefore it's very heavily focused on big US tech. Those with a more globally focused portfolio, or those that invest in small and medium-sized companies as well as large companies, will want to keep an eye on the performance of other indices as well as the S&P 500 index. On this chart here, we're comparing a few different indices in percentage terms on a 3-year basis. The S&P 500 is there, and that's the dashed one, up over 20% in the last 3 years. The UK's FTSE 100 is in black, and in the middle, in the blue and the green, we've got the FTSE 250, which contains medium-sized UK companies, and the MSCI World Mid-Cap, which contains a global spread of medium-sized companies. And then at the bottom in the pink, we have the MSCI Emerging Markets Index. It's also helpful to be aware of the performance of non-equity assets such as bonds and property. In green, we've got the iShares UK Property Index and the iShares Core Gilts Index, which shows the performance of UK government bonds with an average of 12 years until maturity. Both of these asset classes tend to be negatively impacted by rising interest rates, and both are still down heavily on a 3-year basis. We're still in the middle of results season and we've got lots of companies reporting every day, and it's been quite reassuring to see a bit of a recovery in some share prices that have been hit very hard over the last couple of years. 3 examples are Adyen, Estée Lauder and Disney. Adyen is a payments provider that suffered an unexpected slowdown in growth in its US business. Estée Lauder is a cosmetics company that arguably relied too heavily on the Asian travel business, which was slow to recover after the pandemic. And Disney has been criticised for spending too much on its new streaming platform, Disney+. All 3 have posted better than expected results this quarter, with Adyen and Estée Lauder achieving better sales than markets had priced in, and Disney making good progress on its cost reduction programme. Do get in touch if you'd like to read our latest research on these 3 companies. And finally this week, the US Energy Information Administration has published its forecast for US electricity generation out until the end of 2025. Electricity demand in the US is set to rise and generation is expected to rise to meet that. And the reason we're expecting more electricity is that the country is trying to reduce its use of fossil fuels and its carbon emissions, and that means more electricity will be needed. The colours on this chart show how the electricity will be generated. The purple at the top shows renewables. So if you compare the purple bits for the first quarter of 2023 and the final quarter of 2025, you should see an expected increase. You'll also see that demand is always high in the 3rd quarter of each year, and one reason for that is air conditioning. Many emerging market countries do experience very high summer temperatures, and it is expected that demand for air conditioning and therefore electricity will rise in those countries as these countries become more wealthy. Moving on to have a look at next week, it's still reporting season. We are expecting results out from the travel sector, including Airbnb and Marriott. And also next week, we do have Pancake Day and Valentine's Day. Have a great weekend, and we look forward to seeing you next Friday.